So we are talking about the debt advantage, and the first advantage, of course, being the lower cost. It's a little bit cheaper, right? It's much cheaper than equity. So we are basically here comparing between, I think last time I said you can either fund your organization through equity or you can fund it through debt. So we are basically comparing between the two there. So debt is very cheap. So we are saying the percentage that's going to be attached to that debt is going to be much lower than that of equity. So why so? What basically determines the cost of um, an instrument, right? So for starters, we already said the cost is the required return, right? So it means that if the cost is high, we are basically saying the investors or the providers of those funds basically require a much bigger return, right? Hence, we are saying from our perspective, the cost is going to be high. So that is obviously going to be attached to, for the most part, the level of risk that is attached to an instrument. So if you want to go into debt, right? If you go into debt, right? If you go into debt, there is a debt is very cheap because the risk that is associated with debt is small. For the main reason that if you are going into debt, you are getting into some contractual obligations, right? You are bound contractually. There is a law that binds you guys together, right? You can't just decide to default without any consequences. So, which makes the risk quite low, right? And again, should the company fail, who gets to get paid first is the debt holders. So whenever the company fails, and then we are now selling a company's assets, the people that get paid first, the people that get repaid their money first are the debt holders. So which makes debt to be much more secure than equity. Sometimes you consider that if you are approaching the bank to get a loan, they want to, sometimes if you are a business, for instance, they need that assurance from your, they'll simply request for your financial statements, right? To have a look and see how well your company is doing, right? Just to see the credit worthiness of your client. That's what they do, right? They want to see that. So that's some sort of a guarantee to lower the risk associated with them giving you money. Sometimes they might even require collateral, you see. So in those circumstances now, or because of that now, debt becomes cheap, you see, than equity. But the equity holders now hold all of the risk, right? Most of the risk, it falls on the equity holders, which are the ones that basically own the company, the ordinary shareholders, right? They carry all the risk. So the only thing that they have, they basically hope that the company makes a profit. And should the company fail, then they are going to lose. They don't even have a guaranteed dividend. You see? So which is why these ones are going to demand a lot. The equity shareholders, these ones are going to demand a lot as a result of the risk that is associated with their shares. So which is why in most cases, if you look at ordinary shares, the required return is going to be a lot higher than that of any type of debt, right? So which is why that's reason number one, which is why debt is cheaper. And then debt also becomes cheaper if you consider the tax advantage, right? What do we mean by a tax advantage? So by a tax advantage, we are basically saying when the accountants are compiling their, what do you call that, taxable income, they are allowed to include interest as a deduction. So which means their taxable income is going to be much less than a company that is not paying interest. So remember that your tax is going to be calculated based on your taxable income. So which means your taxable income, once it's less, your tax is going to be less. So we refer to that as a tax shield, you see. So which is why I think you realize much later that when we're now calculating the percentage, right? When we're now calculating the percentage for the cost, right? The cost which is the percentage for debt financing, most of that kind of debt financing is gonna attract a tax shield or a tax bracket. It's gonna be within that tax bracket, so we are gonna be deducting the tax percentage on that. But we will have a look at that when we are doing the calculation. So basically, this is it here, what they are talking about. If suppose it's 10%, company has borrowed, in this instance, they have borrowed, and then they need to service that debt at 10%, then effectively it means that the interest is 7.2. If you're going to, if the tax rate is 28%, and then if you're gonna factor that in, then it's gonna be 7.2. That's basically what you are paying there. All right. And then I think this year I'm gonna leave you guys to go through. So all of this here describes what we are talking about, the debt advantage. So you can just read through. So this is just only important to the extent that it helps you answer your questions. Right? It helps you answer your questions. All right, and then let's talk again in brief about the shareholders' required return. Right. So the reason why this one is higher, right? The reason why it's higher, for instance, is because they are the ones bearing all the risk, which is the business risk. So business risk is obviously associated with the risk of a business failing or a business doing well, right? So this one is a given. But again, your KE, of which we normally, KE basically denotes your cost of equity, is going to be a combination of the risk of the whole organization, which will, in some instances, include financial risk, right? So financial risk comes by when a company is debt financed. When a company goes to debt, it increases financial risk. So what is financial risk? It's basically the risk of default, right? So that risk basically increases whenever a company gets into debt. Which is why KE, for the most part, is always going to be increasing. So obviously, if you are an ordinary shareholder and then you realize that the company where you have your shares certainly certainly has gotten into debt, right? It's gonna obviously push you to make more demands in that organization, right? Because you feel like now there's a bigger risk that this company is gonna fail because now they are in debt. So financial risk basically means that these guys are now tied down with some obligations. They need to be making periodic payments as well as a capital payment at the end of the period. So which means it's likely that there's going to be less money for you as an ordinary shareholder. So which means your demands are going to go up. Your cost of equity is going to go up. So this is what is reflected there in that graph. So if a company is all equity financed, you're basically going to be having business risk. But once you start including debt, then there's financial risk that's going to be involved. Then your required return is going to increase. It's basically going to go up. All right, and then financial gearing, again, we're still on the capital structure. We're basically looking at by how much is the company financed by debt and by how much is the company financed by equity. So that's also in the ratios that we gave out the other week. So basically those ratios can help you assess financial gearing, right? To assess and see to what extent is this company financed by debt, or to what extent is this company financed by equity. So that's also just a simple stuff. So other than applying that in ratios, I think, and putting in some commentaries there, you are really not going to have to do much with that. All right, so what has been established so far The cost of debt is lower than the cost of equity due to lower risk, lower expected returns, and the tax advantage. Introducing debt finance in the firm's capital structure brings with it financial risk, which increases the cost of equity. And then financial risk, financial gearing, which is taking on debt, improves the return to shareholders in good economic times, but may lower the return when the economy is struggling. I'm just going to explain that quickly. Let's start with what happens when the economy is struggling. Right? When the economy is struggling and you've contractually bound yourself with some debt instrument, you still have to pay those interests. You still have to pay those interests. You see. So which means you might be in trouble because when the economy is struggling, your sales are most likely not good. You see. So remember, when you take up debt, say, to increase the company's operations, right? But what happens if the operations are down for reasons that are beyond your control? The economy is an external factor. There's hardly anything that you can do when the economy is struggling. So you've gone and you've taken a loan, and then with that loan, you have, let's say, bought some raw materials and you've manufactured some stuff, but the demand is low, right? The demand is low because the economy is struggling. So which means the organization is going to be in trouble because at the end of the day, you need to repay that interest, right? You need to honor your pledges with the bank. You see, so which is the opposite of what happens when the economy is good. So when the economy is good, if you take a loan and you boost your operations, it's gonna pay back. Right? We assume that there's gonna be a payback. So, but whenever you're analyzing any of these things, you need to take into consideration the context. You need to take into consideration the context that you are dealing with there. All right. So weighted average cost of capital, this one, we're going to deal with it our own way, right? So on this part, we will end with the traditional capital structure theory, right? Just a brief description of what's going on here, right? And then we'll quickly look at a question, see what question we can do. All right, so weighted average cost of capital, we are basically weighting. We are saying, okay, there is on the one end the cost of equity, and then on the other end the cost of debt. So when we are basically weighting these two, we are basically getting a balance between those two, right? Saying, all right, on average, because a weighting is more of an average. So we're saying on average, what is the cost of the capital that is financing this organization? So a good way or a good place where this can be used is, for example, let's start off with cost of equity. Suppose it's an all equity finance company, and then you want to engage in, say, in a project, and then the project is going to pay you back or give you a return of 20%, but your required cost of capital is 25%. So it obviously wouldn't make sense for you to have a project that gives you 20% while your required cost is much more than that, which is 25%. So this cost of capital is used as a benchmark with which we can measure our projects. Whether or not to accept a project will depend on whether or not it exceeds this benchmark. You see, but now we are saying in most instances now you are not just going to be dealing with the cost of equity, but you might also have debt within that mix, right? Within that cocktail, you will have debt. So how do we know now? Do we measure it against our debt or do we measure it against our equity? So we can't do either and leave out the other. Hence, we need to weight those two and say on average, our cost of capital is this amount, so which is our weighted average cost of capital, but we'll be doing the calculations for that shortly. So the traditional capital structure theory basically believes that there's an optimum level of weighted average cost of capital, right? How so? The cost of debt is usually given, so it normally starts off as a straight line. If you go to the bank, the interest, say, is 18%, that's going to be your cost of debt, right? But remember now, your cost of debt is always lower than your cost of capital, sorry, your cost of equity there. So it means that if you introduce debt in an all equity financed company, so if you weight those two, it means that the cost is going to be lower, right? So hence you see this is going down. So which means because this is low, this is basically pulling that down, right? It's pulling that down if you weight that. So the more you keep adding that, the more you keep adding debt, it keeps going lower merely because debt is cheap, right? So remember, if you're adding debt here, we are basically looking at this in terms of proportion, right? The more of debt you have than equity, it means the cheaper it becomes, right? But this can only work up to a certain point. So that point there is what we call the optimum level or the optimum weighted average cost of capital. So which is that minimum point there. But once it exceeds that minimum point, it begins to rise, because remember, we said earlier, most of the time when you keep adding debt, your ordinary shareholders can tolerate this up to a certain level of time. Remember, you are increasing financial risk in the organization. So the higher the risk, your KE is going to start going up. Right? So when your KE starts going up, it's going to pull this higher. Right? It's going to pull that higher a little bit. And then it also gets to a point where your debt funders can't tolerate your level of debt also. Then they start requiring a higher return. So a good example of what would happen here for your KD to go up would be, say, suppose you are the bank, and then a company approaches you and they want to get credit, they need credit extended to them. You request, obviously, a copy of their financials. Then on that copy of their financials, you realize that they owe basically every other bank in the market. So which means the risk that is associated with this company is high because they are owing a lot more people. You see this whole straight line here, this whole increase from that point to that point, it basically indicates more and more debt that is being added to the organization. So which means more and more financial risk. So up until even the people that are giving you debt can't take it no more, and they say you are going to require a bigger interest on that debt because you are now a high risk client. You see, so that will therefore further push that weighted average cost of capital up. That's what happens there. So at the end of the day, what we are basically saying, based on the traditional capital structure theory, is as a financial manager, it's very wise for you, obviously, to keep your weighted average cost of capital low as possible. Right? It's very good to keep it as low as possible because this affects, as you are gonna see much later in the module, this affects the value of a company very much. Right? It affects the value of a company very much. If the weighted average cost of capital is small, then the value of a company is gonna be big. So you prefer to be somewhere there. So if you are a smart financial manager, therefore, you are going to carefully maneuver this trade-off between your KE and your KD. You see, but this is what the traditional capital structure theory states. But other than that, we have the other one. So this is just an illustration there of all that is being discussed. But other than that, now we have the M&M theory, so which basically disregards all of that. Basically disregards what we're saying. They basically do not believe that there is an optimum weighted average cost of capital. Why so? M&M argues that the cost of capital is independent of the capital structure. So in other words, the weighted average cost of capital is not affected by the capital structure at the end of the day. This is what they are saying. So they are basically saying it's all gonna be the same. It's all gonna be the same. There you go. So whether you increase your KT or increase your KE there, the weighted average cost of capital is gonna be the same as that of an all equity finance company. So it's just gonna be the same. Remember, we said at the starting point here, your level of risk, if this is an all equity finance company at that point, your level of risk is just business risk. So they are basically saying it's all the same as a result of this arbitration process there. So they basically disregard what was said there. All right, but we will talk about this some, maybe, let me say, give it 2 or 3 sessions from now. We'll talk about that. All right, so we'll work through an example now. We'll work through an example on the weighted average cost of capital. So I think the other recording had another question, so I will get from another question for today. One that is straightforward, since it's starters. One that is straightforward. Let me see the paper that was done today. I think there wasn't much complications on that one. Right, the paper is in the group. Right, the paper is in the group, so you can as well check that out there. The paper. So we're gonna be utilizing that Excel sheet. Let me share the paper there, but you have the paper in the group there. I think question number 1. All right. Calculate the weighted average cost of capital of Checkers as required by the directors. Okay. So like in any other question, you always start off with the requirements, right? To see what are you looking for there. Right. So when you're calculating the weighted average cost of capital, you therefore go to the equity and liabilities here. Right. This is what describes who are the providers of your capital. Right. So we have our equity, and then we have, so you basically want to look at all the instruments that are there. So it looks like we've got 1, 2, 3, 4. Right. So we are gonna copy them each. So let's take the long-term loans. Right. So I'm just copying these to the Excel sheet there that I opened. So I'm gonna take you there as soon as I finished copying. So the first one, of course, is equity. I'm gonna write that as equity, and then the next one is the long-term loans, and then we have debentures. We have debentures. All right, I think the screen sharing there is paused with reason. Okay, and then we have the preference shares. All right, let's do a new share anyway. Right, this is what I was copying there. So here we have instrument. Here we have instrument. Right. I feel like that's stuck on the corner there. All right, so this is the method that we use with our calculations here. This is the method that we use. So first thing that you do is to list down what's on the instruments there. And then the other thing that you want to check, before you go a step further, after you've listed the instruments there, you go back to the question. But I assume maybe you would have had time to read through the question. But just peruse through the question and see what's given. right? And see what's given. So our first preference when calculating our weighted average cost of capital is to use the target capital structure for reasons that we'll talk about again next week, right? We use the target capital structure. Then if that fails or if that's not given, then we want to work with the market values, right? We want to work with market values. Then if we don't have access to market values, then we can then use book values. Book values are the balance sheet values, statement of financial position values, right? So the reasons why you might choose one over the other has got to do with what you're going to be using your weighted average cost of capital for, right? What you want to use the calculation for. But usually, if it's a question that carries a lot of marks, expect that you will be using market values, right? So here, because I already read through this in the morning, I know it's a market value. So this will, in any case, give you a hint, information here. They wouldn't give you so much information for nothing, but you always need to make sure, right? You always need to make sure, right? So once you've got that settled, then that's going to determine what you're going to put there. So we need the market value right here. So we need the market value of equity, long-term loans, debentures, and preference shares. And then obviously you use those market values to come up with the weight, right? You wanna weight these, right? And then of course, once you have the weight, you need the cost of each and every one of these. Then if you multiply the weight and the cost, it's gonna give you the weighted average cost of capital right there. Okay, I'm just gonna make all these bold there just for good presentation. So the market values here, let me just prepare that our numbers don't look confusing there. All right, so this here is gonna be, let's put that under working number 1, right? And then on long-term loans, we can put that under working 2. And then that's there is going to be on working number 3, debentures, working number 3. So the difference between an ordinary loan and debentures is that debentures, you can trade debentures. You can trade debentures on the stock market. Debentures is basically broken down loans. Say it's a huge loan of, let's just say it's 5 million. Let's assume 5 million is a big amount for today. So instead of approaching a bank to get a huge loan because you are high risk, right? A loan, this is financial risk, right? So instead of approaching a bank or another financial institution and asking them outright to give you 5 million, you can break it down into chewable chunks, if I'm to say, right? Break it down, say, into chunks of 1,000, right? Into chunks of 1,000. So 5 million divided by 1,000 is going to be 5,000. So if you break it down into chunks of 1,000, you make them debentures, right? And you issue them to the public. So you're basically looking for 5,000 people that can lend you 1,000 each. That's very easy. You can easily get 5,000 people that can give you 1,000. Now you have 5 million. And then again, because I say this is tradable, so where does this trading occur? Remember, it occurs on the secondary market, right? So which means whoever bought these shares from you or bought debentures, you can basically resell them to the next person. So it's unlike a loan. You can't resell a loan to the next person, but with debentures, you can do the same, you see. So which means debentures will have a market value that's going to fluctuate, right, based on the interest rates or the demand. All right, so let's start with our equity. So let's have our calculations there. Calculation. So if you can write down with me, the better, right? The better, because you have this in the group, you have the question in the group, then you can rework it out on your own and see if it makes sense. All right, so what are we calculating for equity? Two things that we need. Number one is the market value. And then number two, we will need the cost there. Right, so how do we get the market value? Usually there are three methods that you might use. Gordon's dividend growth model can give you the market value. And then, in fact, it's two methods for market value. Gordon's dividends growth model. And then you could also make use of, say, ratios, right? You could make use of ratios. If you check on that paper there, they are investor ratios. So any of those ratios that can give you, that make use of the market price can be used here. But basically, because you are looking for the market value, most of the time you are going to be given, like in this instance, the authorized share capital is 10 million. So what do we mean by authorized share capital? We basically mean that you cannot issue shares. Your number of shares basically cannot exceed 10 million, right? They cannot exceed 10 million. So this is going to come in handy at some point when you're doing questions and you need to decide if a company should issue more shares or should go into debt. So have a look at the authorized share capital. So sometimes it could be convenient for a company to say, get more equity, issue more ordinary shares, right? But look at the balance sheet and then look at the authorized share capital. So that will help you assess if the company is flexible enough to issue shares to the public. So that's where this becomes important. So don't just ignore that there. Right, and then the current ex-dividend market price per ordinary share is R1.50. So ex-dividend simply means that the dividend has not been added there, right? So it's just a clean price, So it's either ex-dividend or cum dividend. So if it's cum dividend, it means this dividend here of 0.25 would have been added to that price there. So we'll take X as it is. We need this one as it is. All right, so it's 1.5, R1.50. Okay, R1.50. So let's see how much shares we have in issue. So we have 8 million shares. So 8 million shares each at R1.50 will give us the market value there. All right, so this is going to be 8 million times R1.50. Right. What is this going to give us? Right. Please just recheck my calculations also. And sometimes I don't write the correct things there. Sometimes I want to write the correct thing, but when it comes to writing and then punch in something else. So please just pay attention there with me. Right, now we need the cost. So we are settled on this one. Now we need the cost. So in terms of the cost now, this is where we can make use of two of these methods: the capital asset pricing model and then Gordon's dividend growth model. We can make use of those there. So any ratio that basically gives you, or any formula, sorry, that gives you KE, you can make use of them. But which one do you use and under what circumstances? It depends with the information that's given. So in our case here, you want to assess your formula, right? And then after that, you want to check what you have, right? What the scenario gives you. Trackers has a historic beta of 1.5. So once you see betas, then you know we are using the capital asset price model. And then the market rate of return for similar shares is 15%. And then the government bonds, I think I remember saying this in one of our classes, that government bonds basically represent the risk-free rate. So this is the risk-free rate there, 7%. So we've got 15%, 7%, and a beta of 1.5. So we can use the capital asset pricing model there. So this one is basically your risk-free rate, and then you want to add your risk-free rate, what you multiply. So your B is your beta there, right? And then what's inside this bracket is called the market premium, right? What's inside this bracket is called the market premium, which is basically the difference between the market rate and the risk-free rate. So it's a premium, it's the gain that you get for not investing on risk-free bonds, right? So we say this was 7%, so 7% plus beta was 1.5, and then we want 15% minus what? Minus 7%. You see exactly what I'm talking about. Typing something else there, right? Minus 7%. All right, what does that give us? Let's see. We can quickly do the calculation there. So let me, all right, I'm gonna perhaps put it in percentages, right? It's fine. So 0.07 plus 1.5 multiplied by 0.15 minus 0.07. So it gives us that amount there. So that's 19%. Okay, not bad. So there we go. We are getting somewhere. Right, we shall move on to the next one. On calculation number 2, it's loans. Right, but before I jump to that one, the other method, hopefully we'll come across it much later, the dividends growth model. Once you are told about dividends, for starters, and then the expected growth rate on those dividends, then you can use the dividends growth model. So the dividends growth model will not only give you your KE, but it can also give you your market price. It makes use of the market price also. So once you're given all that information, then just go through with proceed with the dividends growth model by Mr. Gordon. All right, with our loan, right, let's assess what's the story with our loan. So all finance costs that are payable annually and all current year's payments will be made shortly. So we expect to make payments there. All right, loans is on number 5. So 11.5% bank loans are not traded in the open market. You would expect that. But Mr. Nkosi, the company project analyst, estimates that the effective pre-tax cost is 4% above the overdraft rate, which is 9.5. So ordinarily, for bank loans, we take them as they are, meaning with this 11.5%, except now that we are told about an effective rate. So if there's an effective rate that's given, then we want to use the effective rate. So the effective rate is 4% above this 9.5%. Let's do that. So it's 9.5 plus 4%. So because it's not traded, because it's not traded in the stock market, the market value is still gonna be the same as the book value. So we'll take that one as it is. But KD, which is our cost of this debt in particular, right? We said it's 4% above 9.5. That's the effective rate. But what else do you want to do? We spoke about this tax deductibility of debt instruments. This is where it gets applied, right? Then you want to check the tax rate. So if the tax rate is 28%, you basically use 0.72 there, right? But sometimes the tax rate could be 27%, so you need to check that. Sometimes it's 30%, you need to check that and adjust accordingly. Yeah? So we are not going to be rigid about our calculations. So 0.04 plus 0.095, right? Then we are adjusting that there for that. So let's make it a percentage. So that's 10%, but let's put it to 2 decimal places, right? That gives us 9.72. And then what's the market rate there? Right. The market rate, it's not tradable, but it's okay. Let me check you there. It's 3 million, I believe. Oh, it's not 3 million, it's 4 million right there. So we're gonna put up our 4 million there. 1, 2, 3, 1, 2, 3. Right, there you go. So we need that 4 million right there. I believe it's easy so far. Nothing complicated with this, especially if you are taking it step by step and you understand what you are doing. Really, nothing is complicated. So you can already see the cost of equity is lower than the cost of debt. That's what you would expect. And then debentures. Debentures is on calculation number 3. So make sure that your numbering is accurate, your numbering is correct. Don't frustrate the markers, right? Don't frustrate the markers, please. It must be easy to follow. Even this can be presented a lot better than what I'm doing here. Right, let's deal with the debentures. So debentures, for the most part, in most cases, will have a market value, right? So the current market yield of similar preference shares and debentures is 10% and 14%. So we want this 14%. Right. So let's write it down before we forget that. So our I there is 14%. Our I there is 14%. But what we want to use that 14% now, we're gonna use it up there after adjusting it for tax. Right. These debentures will mature in 3 years at a premium of 10%. Then the premium is only payable a year after maturity. Right. So she's gonna be in 3 years. Okay, let's do the calculation for that there. So which means now we are not told anything about the market value, so we'll make use of the market rate to calculate, to estimate the market value of this instrument. So CF1, and then, all right, CF1, okay, let's just quickly check what calculation you need to put there. So what we're doing now, because we're using this interest rate, 14%, to estimate the market value of this, debentures, we need to check the cash flows. We need to use those cash flows to estimate the value of that. So the cash flows that are obvious are the interests, right? The cash flows that are obvious are going to be the interests on that. So these debentures are 11%. So we'll use that 11%. 11% of what? Of 3 million, right? So let's just write it as 3,000 for simplicity. So this is going to be equal to, so the first here it's gonna be 11% times 3 million, and then CF2. So these mature in 3 years time, no? So it's 11% times 3 million. So this is the maturity date there, so, or the maturity year. So we still need to pay the interest on that year, but not just the interest, we also want the capital amount. Yeah? And then they said a year later, what else needs to be paid? That premium. Yeah? So CF4, is it 10% premium? Okay, I'm gonna check that. I believe it's 10%, but we'll recheck that 10% premium. So this one needs to be repaid on that year. So let's just see if we got our figures okay there. So 11% of 3,000, yes, that's okay. And then the story, so it matures in 3 years. Okay, that's okay. And then the premium is only payable a year after maturity. So that 10% is payable a year after maturity. Okay, we've got that right. All right, so we will do the calculations, therefore. We'll do the calculations. So this here is going to be 0.11 times 3,000. And then this is the same. Let's take it as it is. And then here it's going to be slightly different, 0.11 times 3,000. And then we are repaying again this amount. All right. So all these here are cash outflows. Yeah? And then here it's 10% times 3,000. All right, we keep it at that. So if you've got a financial calculator, this is where it comes in handy. Right? We need to compute our present value. Right? So which is basically the same as computing your net present value. Right? So I make use of an online calculator. We are going to be done now. Right? We are going to be done now. So I'm just going to show you on this online calculator here, but of which you can also repeat the same things on your calculator. The rate is 14. Right here we've got nothing. Here I believe it was 330, right? 330, and then we had another 330. Here 330, and then we had 300 there. Right. So I'm using this to calculate NPV. Right. There you go. So you can just punch it in also on your calculator. But if you don't have a financial calculator, then you can use the online one. So it's 2968.68. 2968.68. All right. So it's 2968.68. Right. We are done. All right. And then our KD, we are adjusting now that 14% to 0.72. Right. I'm gonna be done in the next few. Minutes. At 0.14 times 0.72. Right, so we get that there. Right, we put it as it is. And then here, this needs to be in thousands, or in millions, sorry. So we can as well just multiply that by a million there. So you can simply adjust that and put 1, 2, 3, and then put 1, 2, 3, 1, 2, 3, just so it makes sense now. So that it just doesn't look like we are picking these amounts from thin air. All right, there you go. Check our debentures as they are. So we are only left with preference shares, and then we are done. All right, just hang on. All right, so preference shares are 10%. Right, the preference shares are 10%. And then what do we know now about these preference shares? So this is current market yield. All right, let me just type that for us. It's 10%. So we normally refer to the cost there as KP. It's 10%. But how do we find KP? KP, which is the market yield, is basically given as PMT, or which is the dividend in this instance. So if you divide the dividend by the market value, it gives you that KP there. Right. So we make use of that in estimating the market value of preference shares. Okay. So of which we know they are worth 2,800,000, and then the dividend is 8%. So 8% of 2.8 is basically going to give you, what's that going to give you? It will basically give you the PMT. Right. So 10%, which we already are given there in the scenario, is equal to 2.8. We say it times 8%, and then we are dividing that by MV. So if you multiply by MV and divide by 10%, it will definitely give you the answer. But I know you can present this a lot better than I, right? So what's the best way of presenting this? First, calculate your 2.8 times 8%. It's going to give you the dividend, right? And then you divide by 0.1. It's going to give you the market value there. So MV is equal to, okay, let's be uniform. So we'll put that there as 224 times 1,000. That's the market value. And then KP is 0.1. All right, let's take that there. So the reason why I do this here, it's in terms of reference, so that in case I make a mistake somewhere down there, once I change the working, it must automatically change on top there. You see, it's just for convenience. All right, so we are done with this now. So we are just finishing this up. So we need a total. So you are basically summing all this up. There you go. You sum that up there. All right, let's just put all this here as a percentage so that it doesn't confuse anybody. Okay, let's do it like that. So in calculating the weight, you are basically taking, say, you want the weight of equity. You take your equity and then you divide by the total. That will give you the weight for equity. For long-term loans, you take your market value, then you divide by the total. And then again, for the debentures, divide by the total right there. And then your preference shares, you're just doing the same thing. It gives you that there. And then for your work, you are multiplying your cost by your weight, right? So you do the same for all of those. You get those amounts. Then the weighted average cost of capital now is going to be the total of those. Ne? So you're basically summing up all those amounts. All right, there you go. So you get your 15 point something. So weighted average cost of capital is equal to this amount here. Let's put it as a percentage. Oops, I missed it. I don't know if we have any questions. I don't know if we have any questions about this. All right, but what you need to be on the lookout for the sake of assignments and examinations, when it comes to your weight here, your calculator is normally going to give you maybe two decimal places or to three decimal places. So our answers are not all going to be the same. So they shouldn't be the same. Let's say if we change this to three decimal places, it's going to be, let's make to two decimal places, it's going to be 0.57, right? 0.57. You see it's already slightly changing there. 0.19 on that one, 0.14, and then 0.11. See, so it slightly gives a different amount there. So which is not exactly wrong. It's just the same. It depends with your rounding off right there. Okay. So any questions? All right. We are out of time.